Friends, in today's podcast, I'm going to talk on the topic interpreting the economy in markets. We are in a year where economic growth will be negative. It will be significantly more negative than was anticipated at the beginning of the financial year. The question is, how soon will we bridge this negative growth and go back to where we were pre-COVID? That itself doesn't have a clear answer. So if you look at the markets seem to suggest that it has clear answers on many things. In effect, the market shows more confidence than it normally ought to. I believe this confidence is a function of people without past cycle experience participating very actively and liquidity being very, very high. These two are combining in the way they are to create the market we have. What about earnings? I think this year we will see earnings shrink. The question is whether earnings will again grow back to where they were last year. Yes, we do have 100 companies at the most which are doing very well even this year. These companies have been valued quite liberally because there is a dearth of performance and most companies are actually showing negative performance. So much of institutional money chasing stocks, it's inevitable that everybody is chasing the same stocks. The categorization of companies into large, super large, mid cap and small cap is also not helping matters because the entire investment universe has shrunk significantly. So wherever there is an island of earnings growth, that island becomes very pricey. That is what we are seeing in the market right now. What about balance sheet health? As far as companies which are in the credit business or who are having debt on their books are concerned, the balance sheet health in this financial year is certain to be poorer than it was for March 20. March 20 itself was not a great balance sheet, but March 21 will be worse than March 20. So balance sheet health is a concern for companies with leverage or companies which are in the business of giving credit. So that is something which is inevitable. But the initiatives of the government to help these companies restore their balance sheets seem to be already taken into account in the valuation of several companies. So market is factoring in that the government will help through its measures on the moratorium and interest, and it will also help by managing the macros better so that there is no risk of a spike in interest rates. So in that sense, all the good news of credit related risks are priced. As far as companies with leverage and which are already created assets on debt are concerned, they need growth. At the moment, they seem to be feeding the pent up demand and a lot of export requirements, typically metals and some other businesses. But we need to see how these companies manage their debt in the coming years and how the growth supports servicing of the debt. Some companies are perilously close to bankruptcy, and we have to see how they are going to quickly raise capital. So the capital raising will be the primary way in which balance sheet health is restored. Otherwise, those companies will simply go under and you will have to take them to the NCLT and the IBC. How is the investment climate? Now, clearly, we will be having some big ticket investments. Where these investments will primarily happen in assets that have already been created, like a REIT will draw big ticket money, or you'll see what you saw in Reliance happen probably in the Adani group and in several other big groups which have already done big ticket investments. They will dilute their assets, stake in their key assets to some extent to raise money and pay down debt. So the money that comes in as investment may only go for deleveraging and not really for growth. So who is going to create the growth capital for investment and who is going to invest for growth? That question doesn't have easy answers, but I presume that this will directly be a function of how the government builds global investor confidence to come and invest in India and how the present animosity towards China and the move out of several industries from China in their sourcing needs pan out into India. So far, not much has happened, but a lot of promise seems to be evident. Many businesses are saying that their principals want to source products which they never sourced before from India. So there is a lot of mixed trends that are coming out. If you look at the actual data, there's nothing evidentiary. But if you look at the feedback and the sentiments expressed by industry leaders, it seems that we are in a reasonably promising phase. So we are clearly having 6 or 7 more months of uncertainty, during which one sector after another will stabilize and go back to the pre-COVID level, and their run rate should be consistent for 2-3 months so that the market can be sure that there won't be further slippages. Post that, the government and industry will have to plan how they're going to bring growth back. So it's going to be a very steep climb, and the markets seem to be interpreting this rather simplistically, principally due to the excessive liquidity. So interpreting the economy now seems to be a lesser priority to the market than interpreting momentum. And that is what worries me. But knowing how the market behaves once it's gripped by such sentiment, that sentiment may probably take longer to go away than people like us imagine. So we need to really be patient, calm, and use opportunities to sell what we want to and raise our cash and invest in opportunities which are completely out of favor with the market. We are seeing irrational valuations not only with expensive companies but also with very cheap companies. So there are two extremes. The question is whether you want to chase the extreme where everybody is chasing, or you want to go and participate in the extreme where nobody wants to participate. The choice is before us, and it is up to each one of us to make an informed choice. Thank you for watching this podcast. Do share this video and subscribe to our channel for regular updates. Thank you very much.